3.5 million. That is the staggering number of unauthorized financial products quietly opened in the names of unsuspecting individuals. A digital phantom menace born inside one of America's most historically trusted institutions. Wells Fargo, a bank that built its reputation on a stagecoach legacy of reliability, orchestrated a sprawling systemic deception that siphoned fees from its own patrons. This was not a sophisticated Wall Street derivative collapse, but a grueling, retail-level fraud perpetrated by thousands of desperate employees. The genesis of this unprecedented betrayal lay in a seemingly innocuous banking strategy known as cross-selling, the practice of marketing additional financial products to an existing customer. If a patron had a checking account, the bank wanted them to also have a savings account, a credit card, and a mortgage. On paper, it was a sound strategy to deepen client relationships and ensure long-term loyalty. In practice, it became the foundation for a billion-dollar extortion ring. Under the leadership of Chief Executive John Stumpf, this marketing tactic was weaponized into an extreme corporate doctrine. The bank launched the Gear 8 into 8 initiative, an aggressive mandate demanding that every single customer hold exactly 8 financial products. This arbitrary number was chosen not for its financial logic, but simply because it rhymed with the word great. The internal atmosphere morphed into a high-stakes pressure cooker where daily quotas dictated professional survival and customer consent became entirely irrelevant. Branch managers and regional executives enforced these impossible metrics with ruthless precision, creating a daily theater of psychological torment for low-level bankers. Employees were subjected to relentless performance reviews, often multiple times a day, where failing to meet the arbitrary 8-product quota resulted in public humiliation and threats of immediate termination. The fear of losing their livelihoods drove ordinary tellers to cross ethical lines they never would have considered under normal circumstances. A fatal structural flaw in the bank's compensation architecture practically guaranteed widespread corruption. Executive bonuses and middle management promotions were tied exclusively to raw account creation numbers, deliberately ignoring the quality, usage, or authorization of those accounts. This blind adherence to a single metric created a perverse incentive system where leadership intentionally looked the other way as long as the daily spreadsheets showed continuous exponential growth in retail banking products. To survive this draconian environment, employees developed a suite of clandestine tactics, most notably pinning and sandbagging. Pinning involved bankers unilaterally setting unauthorized personal identification numbers for customer debit cards, effectively activating accounts without the patron ever knowing. Sandbagging occurred when employees hoarded legitimate customer applications, delaying their processing until the next month to ensure they would meet upcoming, increasingly impossible sales quotas. The human cost of these manipulated metrics fell squarely on the shoulders of everyday consumers. Unsuspecting patrons began noticing mysterious overdraft charges, annual fees for credit cards they never requested, and inexplicable late penalties draining their legitimate balances. Worse, the unauthorized credit inquiries and ghost accounts severely damaged victims' FICO scores, the fundamental credit rating that determines an individual's ability to secure a mortgage, rent an apartment, or purchase a vehicle. While consumers suffered silent financial bleeding, the artificially inflated metrics created a massive distortion in the broader stock market. Investors, completely unaware of the underlying fraud, viewed the soaring cross-sell ratios as proof of retail banking dominance. The company's stock valuation skyrocketed, cementing its status as the most valuable bank in the world by market capitalization, all built on a fragile house of fabricated data and forged electronic signatures. The facade, however, could not remain perfectly sealed forever as internal fractures began to show. Courageous employees, disturbed by the rampant forgery, began calling the company's confidential ethics hotline to report the systemic abuses. They detailed the daily reality of forging signatures, creating fake email addresses, and shifting tiny amounts of money between accounts to make the fraudulent products appear active to automated auditing software. Instead of triggering internal investigations, these desperate pleas for oversight were met with swift and brutal retaliation. The Human Resources Department, functioning as a shield for the executive suite, routinely identified the whistleblowers and terminated them under the guise of tardiness or minor insubordination. The corporate machinery actively purged its most ethical employees, ensuring that only those willing to participate in the deception remained to drive the stock price higher. The impenetrable wall of corporate silence finally cracked in late 2013 when an investigative report by the Los Angeles Times exposed the toxic sales culture. This journalistic breakthrough caught the immediate attention of the Consumer Financial Protection Bureau, a federal agency tasked with shielding the public from predatory financial practices. Regulators, initially skeptical of the sheer scale of the allegations, began demanding internal communications and raw data logs from the bank's servers. As federal investigators dug deeper, they uncovered a decentralized management structure that had allowed the rot to fester in plain sight. Regional executives operated their territories like independent fiefdoms, actively shielding their fraudulent methodologies from the Central Risk Management Division. This fragmentation meant that even if a few compliance officers noticed anomalies in one district, they lacked the enterprise-wide visibility required to recognize the fraud as a national, systemic epidemic. The resulting regulatory audits laid bare the staggering, undeniable volume of the deception. Investigators discovered that the bank had quietly fired over 5,300 lower-level employees over a 5-year period for opening fake accounts, yet never once reported this massive wave of systemic fraud to external regulators or its own shareholders. The sheer number of terminations proved that executive leadership knew exactly what was happening, yet chose to protect their lucrative compensation packages over customer security. When confronted with this undeniable evidence, the highest echelons of leadership attempted a masterclass in corporate deflection. Executives, including the head of community banking, Carrie Tolstedt, vehemently blamed the crisis on a small faction of supposedly rogue employees who lacked moral fortitude. They refused to acknowledge that the relentless sales pressure, the impossible quotas, and the threat of termination were the actual architects of the widespread forgery. This strategy of shifting the blame spectacularly backfired during grueling congressional hearings that captivated the nation. Lawmakers from across the political spectrum publicly dismantled the CEO's defense, exposing the hypocrisy of a leadership team that pocketed hundreds of millions in bonuses while firing the very tellers they had coerced into committing fraud. The televised unmasking shattered the carefully cultivated image of a folksy, community-oriented institution, replacing it with the grim reality of unchecked corporate greed. The immediate fallout from these hearings sent shockwaves through global financial markets, obliterating billions in shareholder value. Institutional investors, realizing the bank's phenomenal growth was a mirage, initiated massive sell-offs that plummeted the stock price and destabilized the broader financial sector. The crisis proved that when a foundational institution's metrics are revealed as fraudulent, the resulting loss of faith can evaporate capital faster than any market downturn. The financial penalties levied against the institution were historic and financially devastating. What began as a $185 million initial fine eventually snowballed into a staggering $3 billion settlement with the Department of Justice and the Securities and Exchange Commission. These regulatory bodies concluded that the bank had engaged in a decade-long criminal conspiracy to defraud investors and consumers, marking one of the largest corporate penalties in modern banking history. The sheer longevity of the scandal exposed a catastrophic failure of due diligence, the comprehensive appraisal of a business undertaken to establish its true assets and liabilities. External auditors and internal compliance teams had completely bypassed this critical verification process, seduced by the bank's record-breaking quarterly profits. They accepted the inflated cross-sell metrics at face value, proving that when financial numbers look too good to be true, the gatekeepers designed to protect the public often choose to look the other way. Long after the fines were paid and the executives resigned, the victims continued to navigate the wreckage of their compromised financial identities. Restoring a damaged credit profile is a notoriously glacial process, requiring consumers to spend countless hours disputing fraudulent accounts with credit bureaus. For many, the damage was irreversible, resulting in denied loan applications, higher interest rates, and a profound, lingering anxiety about the safety of their personal data within the modern banking system. In a move unprecedented in American financial history, the Federal Reserve stepped in to deliver the ultimate regulatory sanction. They issued a binding asset cap, legally restricting the bank from growing its balance sheet or expanding its operations until it could definitively prove that its toxic culture had been eradicated. This draconian measure served as a financial straitjacket, suffocating the bank's ability to compete and sending a terrifying warning shot to every other financial institution on Wall Street. The most chilling realization to emerge from the ashes of the scandal was that the fraud was not an anomaly or a glitch in the system. It was the exact, intended output of a perfectly optimized, albeit deeply unethical, corporate machine. The bank had successfully engineered an environment where the easiest path to professional survival was the systematic exploitation of the very people they were sworn to protect. The echoes of this massive deception resonated far beyond the walls of one specific institution, fundamentally altering the landscape of retail banking. Competitors across the globe quietly initiated emergency internal audits of their own sales practices, terrified that a similar culture of coercion might be lurking in their own branches. The era of unchecked cross-selling came to a sudden, grinding halt, replaced by an atmosphere of intense paranoia and heightened regulatory scrutiny. Ultimately, the fake account scandal stands as a monument to the destructive power of misaligned incentives and unchecked corporate ambition. It proved that when a company values arbitrary metrics over human decency, the resulting corruption will inevitably rot the organization from the inside out. The betrayal of millions of unsuspecting customers serves as a permanent, glaring reminder that in the high-stakes world of modern finance, public trust is the most fragile asset of all, and once shattered, it can never be fully restored.